Well, hi everyone. Thank you for attending this webinar. Hope you're all doing well. This is Mike Moffat, Senior Director of Policy and Innovation at the Smart Prosperity Institute, coming to you live from a little home office kind of put together over the weekend because it looks like we're going to be here for a while. So this is the final of this series of webinars called Invest in a Skilled Workforce for Growing Sectors, Budget 2020. So in this series, we had 4 webinars on things that we might see in Budget 2020. Now, obviously, Budget 2020 is not going to be happening for a while, but I still think this is a useful exercise. And in fact, in some sense, it's actually more useful now because we're likely to get a lot of stimulus spending when we do finally have a budget, just given the current economic conditions. So I think, in fact, we may even see more of these ideas, or these ideas pursued more aggressively than they were before. So we have our 4 ideas: unlocking barriers to private investment, tax incentives, 2 billion trees, and growing and investing in a skilled workforce. All that to say, we're going to have another webinar series in April. So we'll be announcing that in a couple of weeks. So keep your eye out for that. So we've got some new webinars coming. So I hope you enjoy these because, again, we've got a whole lot more. So just to recap the first few webinars. So Webinar 1 had sort of a grab bag of ideas that we cobbled together looking at announcements that the government had already made, like trial balloons they had floated. But we also looked at the Liberal platform, obviously because they were elected, and looked at what they were promising in that platform to get ideas of what could be in the budget that would involve a green economy. So the first webinar talked about a number of ideas, including this one on lowering corporate tax rates for zero emissions companies. Then we transitioned to tax. We said, okay, in the first webinar, we said, okay, here was one tax idea that the Liberals said that they were going to implement. Well, what else could they do on tax? So we identified 4 specific areas: investor tax credits, flow-through shares, accelerated capital cost allowance, and tariff elimination for clean tech inputs as tools that the federal government could use to accelerate clean growth in Canada. And we talked about, what each of them would do. When would you use one over the other? What are the pros and cons, and so on. And I should add that all of those webinars are available on YouTube and on our website. So if you missed it, that's okay, because you can go back and view it. Number 3, we talked about 2 billion trees, again, which was an idea that was, or a policy plank that was in the Liberal platform. So we looked at, okay, how would they actually accomplish this? What would it actually accomplish? What would it cost? And those ideas. This final webinar on skills is a little bit different, and it's a little bit different because it's a little lighter on policy. So I'm going to talk about a few policy ideas at the end of this, but I have to admit, unlike the other ones, I don't actually know what the best policy is here. I think some further research needs to be done. And in fact, this is an area where we very well may explore next year. But this is an area where we know some thinking has to happen, but this is an area that the government should pursue. And we're going to talk about why they should pursue it, why this is so important to pursue. And we'll talk about at the end some potential options. I don't know which are best, and there's other ones that we won't discuss that are worth exploring, but I really want to motivate the problem. So this webinar is going to be more around the motivation and the need for policy rather than the policy itself. Here's why we need it. So in order to meet our Paris targets, either our 2030 target or our net zero by 2050, we've done some economic modeling on this, and we'll show it to you. Dave Sawyer and his team did some modeling on this. And what it shows is that, in fact, this is going to create a lot of jobs in the skilled trades and the construction industry. And we'll talk about why, but just the climate action will create jobs in some sectors, reduce jobs in other sectors. But in particular in the skills trades, it's going to cause demand for these jobs to go way, way up, which normally is a good thing. Normally you go, oh, well, that's fantastic. We're creating a bunch of new jobs. That's great. Well, when I talk to the sector about this, their reaction is kind of like an, oh no, that's a problem. And why it's a problem is that Canada is already facing a crunch in the skilled trades. There's a construction boom that continues to go on. There's a wave of retirements that go on. So the sector was already struggling with how will they get all the workers they need. And then it turns out they're going to need a whole bunch more. And I've presented this work to the industry, and that's the reaction I have. It's the only time, I've been doing policy work a long time. It's the only time I've ever seen it where I talk to an industry group and go, hey, here's something that's going to be really good for your industry. And the reaction is, oh no, like we already have too much work. We don't want more work. So again, it's a very interesting reaction. So if you want to go for the full report, we look at how carbon taxation and carbon prices will impact the construction industry. Full report is on our website. Okay, so what we did, we only mapped this out to 2025. We were more interested in the sort of medium-term implications. We said, okay, in the medium term, what are the implications for GDP, for jobs, for investments, if Canadian governments, federal and provincial, ramp up carbon pricing in order to meet their Paris Agreement commitments? So we used this gTech model from Navius, and we mapped out two scenarios. The first is a base case. So we basically say, let's assume whatever policy existed in 2018 continues to exist going forward at the same stringency. So basically, we just hold all policies constant and say between now and say 2030, because we mapped this all out with Paris, we go between now and 2030, let's assume policy environment does not change. We don't change anything. We don't change the stringency. Whatever exists, exists. And then secondly, like the movie Spinal Tap, we ratchet this up to 11. So we go, okay, what we're going to do is over time, slowly, but we're going to ratchet up carbon prices over time so we can hit our Paris commitments. And that's, all the policies that existed back in 2018. So, places that had carbon taxes kept that, places that had cap and trade kept that. We just ramped up the stringency of a suite of existing policies in order to hit our Canada's Paris commitments. So here's what the economy looked like in 2015. Now these are 2025 dollars. So we inflated these dollars by 2% over time to 2025. And in terms of 2025 dollars, Canada in 2015 had a $2.3 trillion economy. If we ratchet that up to the base case, so this is the case where there's no policy changes whatsoever, it goes to a $2.8 trillion industry, and the value of the construction industry, the output of the construction industry, goes from 173 billion to 210 billion. So we basically break down, the private sector, actually the public sector as well. We break down all industries into 6 big buckets: services, manufacturing, construction, utilities, transportation, and resources. So GDP in 2025, nominal GDP in 2025, or I suppose real GDP in 2025 using 2025 dollars is 2.8 trillion. Do the same thing using our aggressive suite of policy, increasing the stringency in policy. And once again, we hit a $2.8 trillion economy. So GDP is basically the same, but not exactly the same. So real GDP in 2025 with this aggressive carbon pricing is about $3 billion smaller than it otherwise would have been. So in fact, our suite of policies actually does reduce GDP. The economy is smaller than it otherwise would be. The economy is still growing massively. It's going from 2.3 billion to 2.8 billion. So it increases by 300 and some odd $billion, but it's $3 billion less than it otherwise would be. But it has huge distributional effects, or not huge, but it has distributional effects. So in fact, some industries, in fact, get significantly larger. Services, manufacturing, construction, utilities, and so on get bigger. They output more in 2025, whereas transportation and resources decline, and don't decline in absolute terms, I should say, but they're smaller than they otherwise would be. So the construction industry is $2.5 billion larger in 2025 than it otherwise would be, a gain of about 1%. So, it's significant, $2.5 billion. So let's look at jobs. So in 2015, we had 18.2 million jobs, 1.2 million of those in the construction sector. That increases in our base scenario to 20.3 million, with 14.3 million, or 1.4 million being in construction. We apply our aggressive case, and again, not a whole lot changes here. 20.3 million before, in the base case, 20.3 million in the in aggressive carbon pricing. But overall, again, there's these sort of distributional effects where two industries, services and construction, actually gained quite a bit, where some others declined slightly. So utilities is basically the same. Manufacturing employment still grows, but it grows smaller than it otherwise would have. And the same holds true for resources and transportation. Overall, the Canadian economy grows by about 40 million jobs. So what ends up happening is that the economy is smaller, slightly smaller than it otherwise would be, but the number of jobs goes up. So the economy becomes slightly more labor intensive than it otherwise would be. And when you look at what sector gains, in percentage terms, the largest gain is in fact in the construction industry. It gains 19,000 jobs. That's, estimate. There's some error bars around that, but the point estimate is 19,000 construction jobs. Second behind only the services industry, but in percentage terms, it's the largest increase. So very, very good for the construction sector, 19,000 jobs. So the top line results, the sector is $2.5 billion larger than it otherwise would be, and has an extra 19,000 or so jobs than it otherwise would have. Well, why is that? Actually, first, I think we can ask, where is that? And there's real distributional effects across provinces, that some provinces gain quite a bit in percentage terms and some lose. So Manitoba goes down slightly, Nova Scotia goes down slightly, but in fact, the biggest, the province that gains the most is surprisingly Saskatchewan. Saskatchewan does really well in terms of the number of jobs in this province, in this scenario, which I wouldn't have expected. I wasn't sure what to expect, but I had to admit, I wasn't expecting that. But once we go through the data a little bit, we'll see why that is. We'll see why Saskatchewan does so well, Ontario and Quebec do so well, and then some of the other provinces mixed results. And what's driving it is largely firm and household investment. So if we look at what industries are increasing their investment, the big one, the big one as far as gains and losses go, is the utility sector. So what ends up happening is when carbon prices are really high, utilities start to change their electricity mix. They want more renewables, they want more carbon capture and storage, which we'll see in a minute, and they want less fossil fuels. And they definitely, coal is just completely not competitive in this environment. So all the coal plants get shut down. They need to be replaced by something. That creates a wave of investment. And what are firms investing in? It's basically, well, we can look at all four of these. Renewable energy, obviously, if carbon price is really high, then solar, wind, things like that, hydro get more relatively cost competitive, so you get a wave investment in that. big one, and it's one of the things that's driving both the results in Saskatchewan and Alberta. Carbon capture and storage becomes, very cost competitive at that point. So you basically go from having, 500 million a year in the base case to about 5 billion in the aggressive case. So the investment goes up by a factor of 10 under fairly stringent carbon pricing. The carbon capture and storage all of a sudden becomes very cost competitive and goes from basically hardly any investment to significant levels of investment. You get investment unrelated to energy, so it's a variety of different things. It's $3 billion, but in percentage terms, it's 1%. It's not much. And then building efficiency and electrification. So that's firms, getting more fuel efficient boilers, a variety of different things to become, have their buildings, have their factories, what have you, become more energy efficient in order to avoid carbon taxation. Households, well, the same kind of story with households. You get investment unrelated to energy. You might go, okay, well, that seems strange, and why is that so big? Well, it turns out what that investment unrelated to energy is housing. And some housing, there's some cars as well. So it's called unrelated to energy, but in fact, it's caused by it's actually caused by the higher energy prices. So basically what households do is, you get a wave of not necessarily retrofits, but you get a wave of new build, older drafty houses don't make sense. So you get a bunch more knockdowns, rebuilds. You get investments in electric vehicles, which is would not be considered a consumption good, would be considered an investment good. And then building efficiency and electrification, right? So basically, people putting in new water heaters, changing, doing retrofits, all kinds of stuff like that. And that goes up by about 30%. It's a huge percentage increase. So that's basically what you end up seeing is you get a bunch of housing retrofits, plus you get a bunch of new houses built, you get a bunch of tear downs, rebuilds, you get a bunch of people investing in electric cars. So other than the electric cars, a lot of that obviously needs the skilled trades. If you're building new houses, if you're putting in new heating and cooling systems, you need sheet metal workers and things like that. So all of that is to say, so this is why we see such an increase in the skilled trades. It's because of this, both the household side and the firm side, they start making a lot of investments that they otherwise wouldn't make, a lot of capital investments that they otherwise wouldn't make. Those things need the skilled trades. So the economic impact of higher carbon pricing shifts economic activity, which is exactly what you would expect. We see kind of a shift away, a little bit away from natural resources, a little bit more into renewables and construction and that kind of thing. Construction industry is a net beneficiary of that. You see an extra 2.5 billion in investments or economic activity, an extra 19,000, 20,000 jobs. Again, there's error bounds on this. And you get a lot more investments by firms and households because they actually react to that carbon price. They go, well, that this didn't make sense when carbon prices are $20 or whatever, but now they're significantly higher. Makes sense for us to make these investments, particularly, and you see that best in carbon capture and storage. Isn't really viable in most applications at a carbon price of $20 or $30, but as you raise that, it becomes far more viable. But as I said earlier, Canada is already facing a crunch in the skilled trades due to a construction boom and a wave of retirement. So we already have an existing construction boom that doesn't look like it's going away, though the current economic situation may change things. And demographics are really not in our favor. The skilled trades are, the average age of the skilled trade is quite old. A lot of these guys started it's mostly guys. There are obviously women as well. We'll talk about that in a minute. But a lot of these guys started working in the 60s and 70s, and they're all starting to retire. They need to be replaced. So when you look at what the industry is actually saying, so the Canadian Construction Association is basically saying over the next decade, 261,000 construction workers are going to retire. So 22% of their workforce is going to retire. Based on hiring rates, if nothing changes, they're only expecting to be able to fill 221,000 of those jobs. So they're losing 40,000 people due to attrition, and then they're actually going to need an additional 40,000 people above that due to increased demand on the sector. So they're saying, like, we're short 80,000 men and women between now and I think they did this in 2018. So between now and 2028, they said, we are expecting to be short 80,000 positions. That's a problem. And keep in mind, when they came up with this number, they didn't have our analysis. They did not have the analysis of what aggressive action on climate would do. So we actually have to take that 80,000, add another 20,000 or so to that. So now we got a shortfall of about 100,000. And when I told you at the beginning of the webinar, this is why the industry was worried. It didn't react, positively when I said, hey, this is going to create a bunch of jobs. This is why. They're like, Mike, we're already short 80,000 workers, or we're anticipating we're going to be short 80,000 workers. Now you're telling us we're going to be short another 20,000? This is a problem. So how do we find 100,000 workers? Again, I have to admit, I don't know what the answer is yet. We are hoping and planning to do some research on this over the coming months. But what we can do is we can look at some of the ideas that are floating out there. Like, what does the industry itself say needs to be done? So I looked at, what the industry, different components of the industry, what they're publishing, what they're saying, their budget submissions, all kinds of things to try and get some ideas of what they think the solutions are. And again, I haven't personally studied these, so I don't know which ones would work better than others. This is, again, this is a plan for future work. I was hoping mainly with this webinar to motivate the need for action. So the Construction Association, just what I spoke about earlier, what they're telling the federal government is they need an inclusive workforce strategy. So part of what they see as being the problem is that, historically they fished in a very sort of small pond when it comes to workers. So they're like, we need to work with the federal government and come up with a strategy to get youth, indigenous groups, women, new Canadians, other represented groups into the construction industry, into the skilled trades. So that's their proposal, which again makes a lot of sense given I think that the industry is about 75% male. I don't know the exact number, but it's disproportionately male. They're like, we need to get more women in the sector. We need to work with the federal government to make this happen. I think I pressed the wrong button then. So the Canadian Institute of Plumbing and Heating and the Mechanical Contractors Association of Canada have been working together, and they've actually come up with some very concrete ideas. They said, well, look, to get people into the sector, we need more apprenticeship. So what they're suggesting is doubling the annual maximum tax credit per year for the apprenticeship job creation tax credit from $2,000 to $4,000, increasing the proportion of eligible salaries that are eligible for the tax credit to 10 to 20%. So basically, make this tax credit more lucrative, and that will incent more people to become apprentices, and just increase the number of incentives. Or apprentices, sorry. The other thing that they're saying is they believe that the federal government should increase their investment in skilled trades promotions, And we see this at both the federal and provincial government, that they've been advocating, people go into the skilled trades. But I thought this was particularly interesting, that these guys, and as far as I know, they haven't seen our research. Maybe they have, but they specifically emphasize the role that the skills trades play in addressing the climate emergency. So these guys get it. These guys are saying, look, the skilled trades play an important role in addressing the climate emergency, and we need to let people know that, because if we do, we think that will help sort of increase the number of young people who are able to go into the skills trades. It will make them interested. I think they're onto something. So another group, the Heating, Refrigerating, and Air Conditioning Institute of Canada, they're calling for a workforce training and adjustment fund for skilled tradespeople that aim to retain or learn new skills that will deliver low carbon solutions. Again, another group that I haven't personally spoken with. I don't know if they've seen our research, but they're saying the same thing. Like, we get it. There's going to be a lot of new jobs from low carbon solutions. We want to make sure that skilled tradespeople, well, first of all, people come into the skills trades, and then secondly, existing workers in the skilled trades can take those new opportunities. And they say they want to provide direct support to contractors and offer funding for their employees to upskill through the Heating, Refrigeration, and Air Conditioning Institute delivered programs. So other policies are possible. I don't want to suggest this is the entire universe of things that the federal government can do. And again, we're just focusing on the federal government. Most of the labor programs are actually provincial in nature, but there's a role for the federal government. But further research is needed to determine the policy options for the federal government to ensure that Canadians have the skills necessary to take those jobs. But the dollars are there. And this is the one really nice thing about this area, is that a lot of money is spent on labor market programs. Like, for instance, the federal government sends the province of Ontario, one province, $700 million every single year under the Labor Market Development Agreement. So basically, some of the money that you and I and everybody else, when we pay EI, some of that money goes into training programs, and it's billions of dollars a year. Then you put all the tax credits and other things on it. We spend a lot of money in this country on labor market programs. So I think we need to think through, okay, well, how can we take the existing pot of dollars and use that to train up workers to take these opportunities? Can existing public policy dollars be better allocated? So in summary, climate action is a job creator in many occupations, including a whole lot of the skilled trades. But the skilled trades are already facing a labor crunch because of the construction boom and because of these demographic pressures. Final thought, also, we're in a very uncertain policy world given COVID-19. And in fact, I don't like being that guy that says, okay, now things have changed. We need my pet policy idea more than ever. But I will say that, here's a situation where that actually might apply, that, we're going to be entering a period of double-digit unemployment. We're going to need a whole bunch of stimulus. What can we do to take some of those laid off workers and get them into the skills trades, so that when we're building these new carbon capture and storage facilities, installing these units, that kind of thing, that we have the workers available, that Canadians are available to take these jobs. So that's it. That's the final webinar of this series. I really enjoyed it. If you have any questions, my email address is down here. Look forward to hearing from you. Again, you'll be hearing from us. We've got some new webinars coming in April. I might even be giving one of them myself. So you may be hearing from me again. Well, take care.